The benefit. So Vanguard had a really great benefit, or a really great piece here. Vanguard writes, tax loss harvesting, a portfolio and wealth planning perspective white paper reveals that from 2000 through 2019, tax loss harvesting helped many investors earn an average annual benefit of 0.95%, an equivalent of almost an extra 1% in portfolio return. That's not insignificant. In separate studies, this which spanned 92 years from 1926 to 2018, the Massachusetts Institute of Technology, MIT, found that tax loss harvesting provided some investors with an average benefit of 1.1%. So there is a benefit to looking at this tax loss harvesting, but don't forget, it's got to be done, not the wash sale window, but the sale of the issue that you want to sell to realize those losses has to be done by 12/31, December 31st. Now, what do I mean by unrealized and realized losses? Some people refer to these as paper losses. Well, I look at my account and they're not really losses; they're paper losses. Well, if you buy XYZ fund and at $100 a share and it's down, $10 a share, then that is a loss of that position. If it's in a taxable account, you could liquidate that. If you owned it for more than 30 days, you could liquidate it. Realize that loss, because what's happening is in your account when you look at it and you bought it for $100 a share and now it's down to $90 a share, that's an unrealized loss. So you haven't realized that. To take advantage of the tax loss harvesting, you have to realize that loss, which means you have to sell it. So you sell it at $90 a share. You realize the loss of $10 a share. However many shares you have, that's going to equal the dollar amount. And then if you wait the 31 after the 30th day, 31st day, you can rebuy that XYZ position. I'm using XYZ as an example. So that's how you realize that to have that tax loss harvested. So what can you do with that? You can offset that loss against any other gain. If you sold something prior or you intend to sell something later, even if it's in the following year, you can use the loss you've realized to offset that gain. So let's just say the loss we were just talking about is $1,000. And let's say it's long-term capital gains. Well, if you have a long-term capital loss. If you have a gain of $1,000, that is a long-term capital gain, well, you can offset that. So you've sold a position, you've had a gain, and you pay. If the wash sale, you follow the wash sale rules, then you have no tax due on that because you've offset this gain with this loss. Now, what if you only have $500 worth of gains? Well, then you can use $500 of the loss and you can either carry the other $500 forward. I have a chart below here from Vanguard that might be a little easier, but you can carry this forward. Or if you have short-term, I'm going to keep it over here, short-term capital gains. And let's say you've got $500 worth of short-term capital gains and you have no short-term losses. So zero. Well, then you can, and you've got $500 left over that you could not use for long-term capital gains, then it can go to short-term capital gains. It first has to go like short-term gains to short-term losses and short-term and long-term gains to long-term losses, but then you can cross over and cancel each other out. But if you don't have that, say you don't have that, then you can carry this forward. So you can carry it forward to next year. Or you can use it to offset income. Up to $3,000 a year, offset ordinary income. So losses can be used in future years to offset gains, or you can use it to offset your ordinary income at $3,000 a year until it's completely depleted. So I hope that makes sense. So I like this chart here from Vanguard. So this kind of shows investment A, $30,000 realized capital loss. Investment B, $25,000 realized capital gain. You use I'm right here. You use $25,000 in losses to offset $25,000 in gains. That leaves $5,000 in losses left over. You use $3,000 of remaining $5,000 in losses to reduce ordinary income. Taxes saved are, in this example, are $1,050. That's $3,000 times 35% ordinary income tax rate. So this person has a high income tax rate. Use the remaining $2,000 to offset future gains. That's in future years, or it could be the same year. If you did this early in the year and you said, I only have $5,000 in gains to use this year, well, you can use them later in the year, or they can carry forward. And this is tracked on your tax return, the loss carry forwards. They can carry forward to offset future gains. Now, what happens if you don't have future gains? What if you don't have any gains that you realize? It might be gains in your portfolio assets that are still in your statements, but you haven't sold them, so you haven't realized them. Then this $2,000 could be used to offset ordinary income, again, up to $3,000. So you can use $2,000 of that to offset ordinary income on next year's, 2024's, in this case, tax return. And if this was, let's just say this was $20,000 that was left over, $20,000, you can continue to carry it forward until it's depleted, or until you have $20,000 worth of gains, or any portion of that to offset that. So you don't have to use it all in one year. You can carry it forward, use it for future realized gains. You can use it for future offset of income. And people don't realize that. I was having a conversation with somebody who lost money on an investment, a business investment, and they lost about $50,000. And they said, "Geez, this is never gonna. I'm never gonna have an opportunity to recoup that money." I said, "Well, at least claim $3,000 a year on your income tax. This is a loss, so you can use that to offset gains." So investment B here, I'm over here on the right, 25,000 realized capital gains. Capital gains owed are $0. Capital gains taxes saved $3,750, because again, you use that you parted that $30,000 to offset that gain. So we saved capital gains tax $3,750. That's $25,000 times 15% long-term capital gains rate. That is subject to your income rates. Your overall income rates trigger those tax rates. So it can be 0, 15, or 20%, and you can have that 3.8% surcharge over a certain amount of income. And the total estimated tax savings of $4,800. That's $3,750 on the capital gains and $1,050 on the ordinary income. So I thought that was pretty good from Vanguard. So that is a really basic overview of tax loss harvesting. Like everything else in the tax code, it is complex. If you want to consider tax loss harvesting, you should have a conversation with someone about it. You should have your team in place. Remember, your team should consist of, your CFP, a good qualified CPA, and at least probably one attorney. And all these folks should be working together. And a good group are going to be having these conversations about tax loss harvesting, planning for your year-end taxes, planning for year-end Roth conversions, and gearing up for 2024. So that remember, that team, they should all be working for you and all talking. So these are the conversations we have on a regular basis when we're talking about year-end planning, and that is one of them is tax loss harvesting, taking a look at gains that you might have embedded in your portfolios and losses that you may have embedded in your portfolios, and see how we can offset that. Now, one thing I didn't talk about is there's a big risk in this. So if you would have liquidated lots of positions in the beginning of October and you had to wait 30 days, and the rules are pretty tight about what is a substantially identical holding. So you liquidated things that you had at a loss, and then you had to wait 30 days. You missed a lot of market movement potentially in October. So that's a risk that you have, because you're kind of sitting on the sidelines. Yes, you can technically replace a holding that's in the S&P 500 with an S&P 500 ETF. That is not a recommendation. It's just an example, but you could potentially do that to have some representation of the markets. I'm using air quotes if you're just listening, but it still may not be the same as the growth you would have in an individual stock. So that there is a risk that that is involved in this tax loss harvesting, and that is sitting on the sidelines. So you've got to determine if the tax savings is worth the risk to you. And it's impossible to time. So anybody tells you this is the month you should do it because this month is always down, that's not always the case. So so take that into account. So that is tax loss harvesting, and that is our program for today. I hope you enjoyed it. I hope you got something out of it. And if you have questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. We're making some changes to our website. They should be coming soon. I know we just redid our website. We're just making it a little bit better for you. So go check out our website at attleborowealth.com and keep an eye on it. We're going to have some good changes. And we continue to work on the Attleboro U site. I'm really hoping that'll be done. I'm just going to put a date of June because every time I put a projection there for a date, it's going to be done. Last one was August. Then I was told October. So we have a new web developer, and I'm hoping that he'll be able to get this done in the next couple months. But I'm going to say in June, we should have a lot of coursework for you. That'll be completely no cost for clients. There'll be some subscription levels for individuals who are not clients, but you'll have some coursework, videos you can go through, and training you can go through so that you can really keep on top of things and see our weekly webinars and go through our financial 15s and all the other educational content we have. All right, folks, have a great week, and we will see you next week. Take care.